All right, all right, all right. I'm back. What is that sound going on in the background? Stand by, stand by. All right, all right, all right. I'm back. What is that sound going on? I got some feedback. Hold on, bear with me. All right, another Monday, 6 p.m. Pacific Standard Time. Ask me anything. Live Q&A. Local mortgage broker. I really enjoy these things, and folks keep coming back. So there must be some value being added. Just conversations about the housing market, about lending, about questions folks have, whether you're a first-time home buyer, whether you're buying your seventh or eighth rental property, whatever it is. I'm happy to answer your questions. And the thing about live Q&A is you might look something up on the internet. There might be a really well qualified and smart mortgage broker, mortgage professional who's answered the question, but if they answered it back in 2017, things change quick in the mortgage world. So you want 2021 answers to your mortgage questions, and that's why you're here. That's why I do this every week, because I think it's great value and benefit for folks, and the feedback I've gotten from folks all over the country, all over the world even, is that being able to ask an unbiased third party, even if they're in process using somebody else. I'm an unbiased third party. You're buying a house in Florida. You've already got, the mortgage person you're working with and the realtor you're working with. You can ask me a question. Hey, does this sound right? Hey, is this right? I'm happy to answer it. And I've got no skin in the game. I'm not going to give you an answer based on anything other than my opinion of how it looks from the outside. So looking forward to jumping into another one. If it's your first time joining, thanks for joining. If you're back, I love to see all the familiar faces. I love to see the chatter, not just back and forth to me and me answering questions, but in the comments, we'll get some feedback from folks on what they're seeing in their markets, what experience they might have based on somebody else's question, and things like that. So as the questions start rolling in, I'm just going to jump right into them. We've already got a few of them. So first one that came in before we even went live, my lender gave me an estimated closing cost worksheet for new construction. Is that usually accurate, or other hidden costs to look out for? If they gave you a genuine loan estimate, it should be accurate. There's some stuff like your homeowner's insurance. You can shop that. And so that's just a guesstimate, right? It might be $900 a year, might be $1,500 a year. They don't know. But the rest of the stuff should be accurate. You asked specifically taxes. That should be on there. And here's something to look out for. For whatever reason, lenders, to make their quotes look cheaper, quote unquote, better, will undershoot how much they're withholding in the escrow account for taxes and homeowners insurance and things like that, where truth be told, it's going to be the same no matter who you work with. So whether you work with me, whether you work with the bank, whether you work with a direct lender, if they need to withhold 7 months of property taxes, prepay a year of homeowners, and then also have 3 months worth of reserves of homeowners insurance, that's the same with me or with anybody else. So if somebody has less being withheld than somebody else, all that is a shell game to make their loan estimate look better. And I see it really, really often in refinance scenarios, right? Where I try to teach people, I've got a video that I showed on how to compare refinance apples to apples. And that's one of the things you got to do is you got to take out all the third party stuff. Just look at box A, because there'll be some manipulation going on depending on how thirsty that loan officer is for another deal. They might be starving. And unfortunately for you as a consumer, it might come across as a little bit, I don't know what you want to call it, bait and switchish. So hopefully that answered your question. James Petrie, thanks for joining. Does a non-recourse commercial loan in a self-directed IRA count towards personal DTI? I thought it didn't, but now lender's saying it does count right when I'm doing a cash out refi. Weird. Thanks. Gosh, how in the heck did they see that? Because in general, a commercial loan shouldn't be showing up in your DTI, whether it's against a property or not. I don't think would make a difference. Like, for instance, if you are a self-employed borrower who has business lines of credit that doesn't show up on your personal credit report, it's not something should hit your DTI or will hit your DTI if you're doing a residential mortgage. I would think that this would be the same. This is non-recourse, meaning that you're not liable for it. You're not personally accountable for it. And because of that, I can't see it counting towards your DTI. I would get somebody either just maybe you challenge them. Sometimes lenders will get a condition from an underwriter, and that underwriter doesn't know that underwriter puts a condition on there. And as crazy as this might sound, here's some mortgage insight for everybody watching. I will probably get, with 50 loans or so in process, 8 to 10 conditions per week. A lot of times it's my team doing it, my processor doing it, my production manager dealing with it. So it'll just get brought to my attention that this condition got brought up on this file, challenged, and we won. This got brought up on this file, challenged, and we won. So underwriters aren't always seasoned, knowledgeable, 100% guarantee. I've got people on my team that are higher level underwriters than a lot of underwriters that are working for some of these lenders. Especially think about it too. In the last year and a half, as mortgage has exploded, as rates have gotten less, underwriters have been hired by the thousands. And so there's a lot of brand new underwriters. This might be a brand new underwriter who's placing it as a condition. And then if your lender goes back to them and says, hey, this shouldn't be counted, this shouldn't be here, they might just win it and it disappears. That is my advice to you. But truth be told, I'm not 100% sure that it shouldn't be counted. It's just my gut that it shouldn't be counted. I'm going to write this down. Non-recourse. Every week I get to learn. Non-recourse commercial in a self-directed IRA. Count towards DTI. That's my notes to myself. All right, cool. Thanks for that question. That's a good one. And one that I think I know, but not 100% sure. All right. Yeah, Serena. Thank you for joining. Love your lives. I appreciate the kind words. Curious about the verification of employment process. We are supposed to provide the loan officer with contact info. Or are we not allowed to provide that info? Oh, of course you do. So verification of employment, for anybody who doesn't know, it's more than just saying, yeah, Serena works for us. It is generally done. We do a verification of employment that's a written one. And so we send in that written VOE to your employer, and you give us somebody in HR. Some big employers just have the work number where it's an automated system. But the reason why we get that is because we're going to have them fill out a form that shows your 2019 pay, your 20 pay, and your 21 pay. Not everybody just gets $5,742 per month. A lot of people get, here's the base, here's the bonus, here's the commission, here's the overtime, whatever it is, right? It's broken down into different segments. And as a lender, what the lender wants to do to figure out how much income they should guesstimate you're going to get in the future is say, all right, in the last 2.5 years, in 2020 or 1920 and half of 21, Serena's got this much in base income and this much in overtime. And we're going to average that over the last 30 months. And so all the base divided by 30, all the overtime divided by 30. And we're going to have a number in both categories. You're going to have $5,400 on the base pay. That's what you've averaged over the last 30 months. And then you're going to have an average of, $275 per month in overtime. And that's why it's important when you've got any sort of variable income for us to do this during the pre-approval process. Because I want to know exactly how much income I'm going to give you. I don't want to guess. And just because you made $78,000 last year and you've made $39,000 year to date this year doesn't mean that we can just divide your year to date by the number of months in the year, and that's what the income we're going to use, because it matters how it's segmented. Perfect example being you made, certain base income in 19 and 20 and a ton of bonus. And then in 2021, your base may have stayed the same or even gone up, but you haven't got any bonus. Well, the lender's going to look at that and say, well, I don't think we should expect to get bonus in the future. We don't have any this year. Or maybe you got it in 19, but not in 20. These are the kind of things that you do this before going out and shopping for a house. And a lot of people push back and they go, why do you need that? Why? I'm just trying to figure out how much I qualify for. I'm trying to get you prepared. I'm trying to do all this work up front so I know exactly what you qualify for, and there's no hiccups in the loan process. I want to know that when we submit an offer, you get an offer accepted, this thing is going to close. We've done this before you even submitted offers. We know exactly your pay breakdown and how much we're going to be able to use. So yes, you're allowed to provide that info, and it helps the lender to provide info. Somebody's going to be responsive. I can't tell you how many times email somebody, call somebody, fax somebody. A couple of weeks go by. The area where we saw the most, I'll call it frustration, was all the teachers and school district employees that we do loans for. It was hard to find admin, HR, and those type of folks because they were working from home. Sometimes they just weren't able to get some of this payroll information for one reason or another, or they had just deuces for the summer. They were done. They were checked out. And so anyhow, that's that. Should my realtor go to an appraisal? If you are on the list side and you're selling a house, I would say 99% of the time you want the realtor to be there. And you want the realtor to be there just to give the appraiser information that'll help them price the home correctly. Sometimes appraisers, as good as they are, they have tons of training and they're well qualified to do their job, but they might not know certain things that your realtor can just tell them. And your realtor is not necessarily trying to influence value, just trying to say, hey, listen, I don't know if you have this, but this one sold down the street. I don't know if you have this, but this addition that they did was permitted. Here's the information on the permits. It was done in 2019. They did a bathroom remodel. Different things that the appraiser 9 times out of 10 is going to appreciate. Thank you for that info. Thank you for the info. It helps them do a more accurate appraisal, right? And if you're a seller, you want that information there so that the appraisal doesn't come in short and it causes an issue with your transaction. If you're on the buy side, you probably want that listing agent to be there as well. It's not as common that the agent on the buy side shows up to the appraisal because it's, unofficially the agent job on the sell side to be there. Sometimes I see that. And so I would just think that the agents would want to communicate. The buy side agent would want to say, is it cool if I show up for the appraisal? And it might be a listing agent. It's like, nah, what are you going to come here for? I got this. Step back. I got it under control. Johnny, thanks for joining, man. Can I pre-qual for new home construction, non-contingent, as if I will rent out my current home, then turn around and sell? Reason being, I heard new builders want only non-contingent buyers. If you qualify for that new purchase using rental income on your last home, then qualify like that and buy like that. And if things change, this is off the record, besides the fact that it's recorded on YouTube, things change, man. You decide to sell. They cannot sue you for selling. And really, the lender is in a stronger position if you sell. So the lender's not going to be upset about it. You purchase this home, and the lender's going to do their due diligence and do a rent survey on the house you're leaving. And you're not going to be able to use a crazy number of rental income, but like you're going to qualify based on you're putting 5% down on this one. You're using departing rental income, because if you left, you could rent it for $2,200 a month. Now, if you sell that place, you're even more qualified. So the lender's not going to be mad at it. So long-winded way of saying, yes. The dude, what's up? Next month, my forbearance is coming to an end, I think. What does this conversation look like? Thanks. Okay, this is what I would do if I was you. And I've gotten tons of feedback. I've had clients of mine who have reached out to me, and whenever they mention forbearance, exiting forbearance, sometimes they want to know if they should refinance. I dig as much as I can to get information from them so I can turn around and, give it to the YouTube nation and help as many people as possible. So from what I am hearing, servicers are going to provide you with plenty of options. And I think what I've heard so far is that it might present you with a number of options and then pause. And then depending on how you react, there may or may not be more options available. Example, a client of mine has their servicer say, are you able to make up the $50,000 in missed payments that you have and just come current? No. Okay. Are you okay with us spreading that out over the next 12 months and you pay an extra $4,000 a month to get current over the next 12 months? I can't do that. I can't pay an extra $4,000 a month. Okay, well, we can just put it on the back of your loan and it can just be sitting on there as a silent second. So if you refinance or sell, you pay it off then. My client says, okay, well, that's doable. I was thinking about refinancing because rates are lower now and I'm in a 3.75. So, and as my client starts to dig, they go, well, if you're interested in a loan modification, because rates are lower now than your current rate. What if we did a 3.125% and we stretched you out to a 40-year loan? Ding, 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 types in some numbers. That would save you about $525 a month. My client says, yes, that sounds like a deal. Let's do it. It was literally no qualifying, no income docs, no credit check, no anything. Here's what we're offering you. For the next 3 months, it's going to be your trial period. You make the 3 payments over the next 3 months, and then you're in this loan modification. And here's the thing. Servicers were told by the CFPB, you have to offer people options. We are trying to create avoidable foreclosures. If somebody is in a position where they're exiting forbearance, we want them to not end up going into foreclosure. We want to do all we can, quote unquote, avoidable foreclosure to make sure we don't have the housing crash we had before. This is the CFPB's words, right? And so they made it clear, like servicers, you must show us that you've offered options, that you've made an attempt to do this. Foreclosures hurt communities. They hurt families. They have a long-lasting effect. We don't want that. Whatever you have to do, just do it. And so loan modifications that I've seen so far are amazing. The lower your rate and stretch you out over 40. Now, not everybody wants to stretch it out over 40 because 40 years is a long time, but ask. That's my advice. It can't hurt, right? The worst answer, the worst they can do is say no. Best of luck, man. And circle back. Shoot me a message. Let me know what they said. I'd love to hear. And as a thank you for answering a question, send me an email, Instagram, Matt the Mortgage Guy, CA for California, or somehow matt@mattthemortgageguy.com. Shoot me a message somewhere. I closed my other browser where I had my other thing up, but I've learned from past lives, I got to ask you guys to smash the like button. So smash the like button. Someone give me an update. If we got 31 people watching and we got less than 20 likes, you guys are weak. What's up, Caden from Orlando? You can smash the like button too. Whatever that does for the YouTube algorithm. One of these next few weeks, we're going to get up to 100 people. About an hour in, we'll be up in the 60, 70 people watching range. And the goal is sometime this summer to get up to 100. Do they really need my last 2 years of my income? What if I have more income last year than previous year? Will they consider my last year income only? Most lenders, sometimes you can only provide last year's, but it's not going to hurt you that you provide 2 years if, like, let's say for instance you got a salary job and you got a raise, right? So in 19 you made 58,000, in 2020 you made 72,000, then 2021 you're on pace to make 80. If it's salaried W2 job, we're going to just look at your most recent salary. And if you're making $68.50 per month consistently, and that's what the new pay is, and there's 40 hours per week, and your biweekly pay is the same, and this is the new pay, then we'll just use that. It doesn't matter what you made in 2019, but depending on what the automated system tells the lender, they're likely going to need 19 and 20 W-2s, at the very least 2020 W-2s. So if your lender asks for it, then the answer to your question is like, do they really need it? Yeah, they really need it. I mean, they're lending you hundreds of thousands of dollars. So send them that W-2. FOMO 2021. Thanks for joining. I recently had 3 properties. One is paid off. One has $100K left in mortgage, but house is worth $1 million, and third 20% down. I refinanced and pulled money out at 3.6. And then I go down. Should I buy my 4th house now? Well, it sounds like you're in a position with some capital and you're able to buy your 4th house. I think the more important question is, coming from an investor, is, are you able to find a deal that meets your criteria? And here's something that, people say, is it a good time to buy? Is it a bad time to buy? Should I do this? Should I do that? If you don't know your criteria, then I can't answer the question for you. But, everybody does it different. Everybody's got different goals. Some want cash flow. Some want appreciation. Some want tax benefit. Some want, retirement and own X number of homes by the time they retire, or have X number of homes paid off. If you can find a home that meets your criteria, then buy. And I think that most investors that I talk to, most investors in my circle, myself included, if a deal comes up that meets your criteria, it's always a buy. And, the last few offers that have gone in haven't got accepted, but that's fine. When something meets my criteria, you put together an offer and you offer. So get clear in your criteria. Do you want something that when you put 25% down has an 8% cash on cash return? If you want something that when you put 40% down, it's going to provide this number of dollars per month in cash flow after all expenses. If you know your criteria and you find something that meets your criteria, yes, you should buy your 4th house now. Mona, how you doing? The article, How I Won a 20 Offer Bidding War for My Client, is only accessible through membership. Oh, that's weird. Was it Inman article? Because I thought I canceled my Inman subscription, but then I made that video with that. I'll find out. I wonder if I could download it as like a PDF or something. Shoot me a message and I'll try to get you that article, because it was a good one. And I guess what you're referring to is I linked it in my video. What was the name of that video? That's a recent one, right? Days are all blending together. I'm working too hard. I'll see what I can do for you. Thanks, Mona. What makes an appraisal come in at the price or higher? Here's a fun fact about appraisals. Sometimes a house will be listed at $588,000 and it sells for list price $588,000. The appraisal comes in at $588,000. You're like, wow, that's crazy how that came in right at value. When you submit an appraisal order, you submit the purchase contract. So the appraiser sees the price which it's in contract at. Now, it's not always the case, but in my experience doing hundreds of loans per year, The appraiser, if it's justified and if there's comps to support it, is going to try to bring the appraisal in at value. On a purchase, they don't want to be bah humbug and torpedo the deal. But here's the thing. If that $588,000 list price turns into somebody offering 640 grand and nothing in that neighborhood of that size has sold for over 600,000, that appraiser is going to have a hard time bringing that appraisal in at 640, right? And so, what makes an appraisal come in at the price or higher is generally comps. I mean, there's no stronger influencer on an appraisal than the comps, meaning the comparable sales. So you're buying a 3-bedroom, 2-bath that's 1,582 square feet. The appraiser is going to look in that neighborhood for the most recent stuff that matches that as close as possible. So they might pull something from 2 months ago that sold, and it's a 3.2 with 1,625 square feet. And they pull something that sold just 6 weeks ago, and it's a 3.2, but it's only 1,422 square feet. They're going to make adjustments, and yours is a little bit bigger, so it's worth a little bit more. And of the comp that's 1,600 and something square feet, it's a little bit smaller, so it's worth a little bit less. And these little adjustments, a little bit better condition, on a better street, more upgrades, all that stuff gives each comparable sale a plus or a minus. You know, this one's bigger in size, and so we got a minus for your house because it's smaller. But it's not as good a shape, so we're going to do plus 10,000 because your condition's better and stuff like that. And so that's how it works. But in general, if you've got a home that is sold, it's got to be in the range of what other stuff in the area has sold for. Is it possible to get a conventional loan with a 1099 or bank statements? 1099, yes. Bank statements, no. If you're talking about, showing bank statements to show income, those loans are available, but they're not conventional loans. Those are called non-QM loans, and it's just a different product with different lenders. And rates are slightly higher, fees are a little bit more, but they're out there. There's debt service coverage ratio loans, there's bank statements loans. If you're a 1099 employee and you're self-employed and you have that income hitting your Schedule C more often than not on your tax return, then as long as you have enough 1099 income, you can qualify for a conventional loan. It's just with bank statements, there's no way to qualify for a conventional loan using income that's derived from a bank statement. Kevin Hawthorne, my buddy from Florida. Today was your first day back at Citrus Connection bus terminal. Man, so that's good to hear, dude. You guys were shut down. I thought Florida was pretty wide open. I didn't realize that some of that stuff was shut down. So congrats on being back to work. If anybody doesn't know Kevin, he's been a volunteer at Citrus Connection in Florida. He's got some cool YouTube videos showing his volunteer work, and good to see you're back, man. I wonder if I'm sure the people that you serve missed you. I wonder if you missed it, just being around people. And I know myself personally during COVID, I'm a people person, man. I missed shaking hands, kissing babies, being around realtor partners, other lenders, CPAs, financial advisors, all the people that we do business with, B2B, missed being around some of those folks. All right. Theo B, another familiar name. Good to see you back. Thanks for joining again. The consistency is what it's all about. Every Monday at 6 p.m. I promised it. And in next Monday, it's a federally recognized holiday, I think, because it's the 5th of July. I'll be here. I'm going to be probably unavailable most of the day, and there's not a lot can be done in the mortgage side because title companies will be closed and whatnot, but I'll be on YouTube at 6 p.m. Count on it. My mom owns a free and clear home, needs to pull out equity. Her SSI income barely qualifies. How do we go about getting equity out? Well, unfortunately, like cash out refinance or home equity line of credit, both of those for pulling equity out of the home are going to require quote unquote ability to repay, meaning your income versus the debt of the new mortgage. And so she'd either have to have a co-signer or something, because they're just going to take $2,000 a month in SSI income. Current debt plus mortgage can't exceed 45% of that, $900. Not going to be a very big mortgage that you qualify for, and there's no real way around it. Lender, rightfully so, I think, and as much as lenders, people might get upset about it, like it's protecting your mom, right? If she was able to pull out a bunch of equity and have a $1,700 payment and only getting $2,100 a month in SSI, like that would be very risky for her. She'd be at risk of losing the house. So in a way, they're protecting moms. If she's the disabled vet who's on the mortgage and on title, then she should qualify for that property tax exemption. She can't like add herself to a current loan or add herself to title of somebody else's house to get that exemption. It's got to be her primary, her VA loan. She's on title and whatnot, from my understanding, in order to get that tax exemption. For anybody who doesn't know, disabled veterans are able to get a property tax exemption where they don't pay any property tax or heavily discounted property tax. How long after buying first home can I buy a rental property? The very next day. It's just a matter of whether or not you qualify. You could buy your primary home and then buy a rental property the next day, and one after that. It's just a matter of qualifying, and qualifying is very similar to that of your primary residence. You make $8,000 a month. You got $400 in current debts. The new mortgage is going to be $1,600. So that 16 plus the $2,000 in total debts. It's a 25% debt to income ratio. When you go to buy the rental property, you're going to add the new mortgage on the debt side, but then you're also going to add some rental income on your income side. And you have to keep that below 45%-ish for DTI ratios. But you got the down payment to do it, and you've got the income versus debts DTI qualifications to do it. Do it. Hi, VQuez. Thanks for joining. Caden, looking to buy an investment property. Should I do a cash out, refi, or Heloc? $150K left on mortgage with about $160K equity. Either one of these, you got to keep in mind. So you got $160,000 in equity, right? Meaning the property's worth $310. If my math is correct, $310 times 80% is $248. So if we got some fees rolled in there, prepaying property taxes, homeowners insurance, all that stuff, $150 to $248, even though it's a $98K spread, maybe it's $92,000 in cash out. You could do it that way. And I think it would depend on what is the current rate in terms of the 150. And even if it is fairly good, I lean towards the cash out refinance because it's 30-year fixed debt that never is going to change. Most Helocs, and let's say you pull out, they approve you for a $90,000 Heloc. Most Helocs are going to be an adjustable rate. If you don't have a good game plan on paying off that $90,000 relatively quick, I mean, some of the scariest stuff I see is that $90,000 might be interest only, and so you're only paying interest on it, but it's adjustable. Let's say for cash flow reasons, you're like, I'm just going to pay the interest only, 2 or 3 years. And then the thing adjusts and it starts going up. You still owe $90,000. The payment goes up because the interest goes up, and then eventually it hits a point where it's fully amortized, meaning principal and interest. Then you might get in a spot where you're caught off guard, and it can be a little bit more risky because it's variable, right? I just like fixed rate debt. It's my cup of tea, but to each their own. Okay, James, I'm going to answer this for you, and I'm going to answer it correctly because wherever you've heard it different, I can assure you I deal with investors all day, day. And so I know this for sure. Let's say you bought something right now and you close on a property, or you're buying a property that's whatever the price is, right? It's going to rent for $2,000 a month. Right away, you can use 75% of that. You can use $1,500 a month. The only thing the lender does is they do a rent survey. It's part of the appraisal. The appraisal is a 1004, is like the code for it, and then 1007 is the sheet that's used for the rent survey. And the rent survey says, 3 bedrooms, 2 baths, rent for about $2,000 in this neighborhood. So that's what the 1007 says, is that this thing should rent for $2,000. Right away, we can use $1,500. I'm 1,000% sure of that. So $1,500 gets added to rental income. Now, next year, you go to buy to another investment property, and we've got your tax return from 2021. Now we're going to look on that and say, this thing had 180 days of rental use, and we're going to, that Schedule E of Schedule of Real Estate Owned, we're going to look in there, and there's going to be a calculation used for how much of that rental income we can use. Unfortunately, from what I've seen, especially with savvy real estate investors and great CPAs, is once it hits your tax return, it's going to be less. It's going to be less than that 75% factor. So like the first year before it hits your taxes, it's going to be better. And then once it does hit your taxes, we got to use that number, and there's no going back from it. They'll just, if you've only got 1 year filed with those rental, that rental income, that's all we use. And if you've got 2 years filed, we average it over the 2 years. All right, Jennifer, another familiar name. I appreciate you being back. Should I buy a house with a contingency of the seller's closing once they find another property? What should I do? I feel like this can take forever. Usually there's a time frame, like contingent on the seller's finding replacement property within 21 days or 30 days. Because you as the buyer, the thing that I would be a little bit weary of is, like you said, if it takes a while, you can't lock your interest rate in until you really know how soon that you can close this deal and things like that. And so I would say I wouldn't be afraid of it, but I would want like a certain time frame on it, because you're going to be sitting in contract and submitting your loan, not knowing, do I lock it for 30 days? Do I lock it for 45? Do I lock it for 60? Do I lock it at all? I mean, it's a little bit of a not so ideal situation, but if the house is the one you really want, then we're in a market where sellers can still call the shots somewhat. It's starting to lean though, starting to lean ever so slightly the other way. If you see my last couple of videos on, demand weaning, supply ticking up, it's happening. I literally made a video 2 weeks ago, and then articles came out like crazy the end of last week that confirmed what I was saying. People are going on vacation. Demand was starting to tick down. And when demand ticks down, that provides more inventory. Stuff's not selling as fast. And so it's slowly accumulating more listings. So if this house isn't the one, you might be in luck. You might be able to find something different where you don't have to, accept an offer like that, where it's contingent on their replacement property. Joey Garessi. You told me how to pronounce that one week, and I forgot already, man. I got a brain that's constantly is like scrubbing and deleting. So I already forgotten. My apologies, but thanks for the kind words, dude. This is fun to me. And whenever I talk to people about YouTube and the live specifically, it's fun to have all the back and forth, do what I can to help people out. I get the gift of people thanking me. I got tagged by some random person on Instagram, and I can't tell you how much satisfaction that gave me. They tagged me, Jeb Smith, Javier Vidania, Lizzie Hoffler, Kyle Seagrace from Win the House You Love, and basically said thanks to all you guys. I learned so much. I was helped so much from all the YouTube folks who were providing value and helping through the home buying process. They were in a completely different state, working with completely different people, but just gleaned the value from YouTube and thanked us all. So that was a win. Like, it's really cool to have all the people I work with in California tag me on something. Thanks so much for the help. Your team was awesome. But to have somebody who's that far away, and honestly, I don't even know what state it was, just say thanks for all the advice and info I got watching you guys during the process. That was cool. So if any of you guys close on a deal and I provided any kind of value, Matt, the Mortgage Guy CA is my Instagram handle. I don't do, well, I guess I do some bids on there, but tag me on there. It'd be cool. I offered $15K appraisal gap. He's bluffing. The seller's bluffing for sure. All the sellers are tough. Get that thing in contract. If it appraises 30K light, just press the call button. See if he turns over a bluff or not. He's going to turn over a bluff. After 4 weeks of being in contract and him starting to see other stuff come up on the market around him, flex your chest on him and see what happens. You're going back down. That's my personal opinion. And I mean, yeah, trust me when I tell you that a lot of big talkers, if you have a quality real estate agent and a quality mortgage broker that you're working with, once you get close to closing a transaction, the seller's going to be like, do I want to put this back on the market? Do I want to try again? Do I want to see a new appraisal and go through all this stuff again, not even knowing for sure? Or do I just want to sell it to this guy for $10K less than I really wanted to? 9 times out of 10, a smart person is just going to be like, all right, we'll just sell it. I would say it's not so common for sellers to do it, but it's more common for them to say it, right? Then they get called in their bluff and they fold their hand. They auto muck. Forgot to mention 4.125 on existing mortgage. So let me see. You're going to pull out some equity. Yeah, lower the rate. 760 credit score. Yeah. You do a cash out refi and be in the low 3s. So that's going to be a good looking refi. That's a situation where the refi is going to be better than the Heloc because you're lowering your rate on your whole mortgage. And so, it's going to appraise at 310-ish, I think you said. Do a cash out refinance to 80%. Get yourself whatever the number was. I think it was 90K-ish out. Go deploy that capital on something that's going to yield you 20% cash on cash returns if you can find it. My family completed a cash out refinance on an investment property. Should we wait until Fannie Freddie has bought the note before transferring it? I wouldn't sweat it, dude. Like I've transferred stuff into LLCs right away. Never been an issue. I don't think that Fannie Freddie is going to pull title records to see how the property is being held. I would worry about that very little. I literally wrote thousands of mortgages and I know hundreds of investors I've worked with have transferred stuff to LLCs. Never once have Fannie and Freddie called and been like, yeah, pay us back. We don't want this. Yep, it went up this year, James. 540. I think it's 548,250. 548,250, and then depending on the county, high balance is like 598 in the county I'm in. It goes up to even 822, 375 in some of the bigger LA counties, San Diego County, San Jose County, San Francisco and whatnot. But yeah, 548,250 is conforming. That's gone up every single year It was even 510 was 2019, if I remember correctly. And then it was 2020 in the 520s. And then 2021 is 540s. So yeah, if you're under that conforming conventional smoking rates, if you're in California, I know a guy, Matt, M-A-T-T at mattthemortgageguy.com. Might want to connect with that guy. He's all right. This team's pretty good. There you go. Moss administrator. Smashed it. Smashed it. Let's see where we're at. I don't know why it's giving me it's giving me like feedback. I gotta turn the volume down on this one. Oh, there we go. Display audio. Turn that down. We'll see how many smashers we got. Excuse me, guys. I don't want all this dead air, but I gotta go take a look. I gotta take a look. I don't know why. I don't know why it even matters. But just curiosity, I guess. Curiosity killed the cat. All right, 28. You guys doing all right? You guys are batting about 600 because there's 50 people watching and 28 likes. So you can afford to step your game up. You could probably bat about 750 from what I've seen in the past. So smash the like button for the YouTube algorithm, right? James, 45 is a good rule of thumb. And this is interesting too, because Fannie and Freddie have slowly but surely like tightened it a little bit. And I talked to a high level executive at a big wholesale lender who told me the number of approvals through the automated system, through Fannie and Freddie's automated system that we all plug stuff into, 1% to 2% down over the last 6 weeks as they tweak it a little bit, right? On some owner occupied stuff, I had a debt to income ratio of 43 on the back end that I could not get approved. And there's other compensating factors, right? If you've got a 44.6% back end, but you've got a 698 credit score, you're putting 3% down, and there's not any reserve funds. Like all those other compensating factors play into it where you might not get an approval. So know that, but just as a rule of thumb, under 45, you should be safe as long as there's good credit and there's reserves and the other compensating factors are strong like ox. Thoughts on using Heloc to pay down first mortgage? Oh man, I made one of my favorite videos on this exact subject. So I'm gonna find it real quick. And Kevin, there's all these. What's the right word for it? Folks who claim this to be like the most magical thing. You're going to take a HELOC, and since it's compounded differently than a mortgage, you're going to apply that to your principal. You're going to put all the money in the HELOC, and you're going to do that, and like magic, boom, like your mortgage is paid off in 2 years. The magic of paying your mortgage off in 2 years was applying extra money towards the principal. And the HELOC, like, what is it, like Debt Accelerator or something? I got to find it now. Playlists. Sometime I made a video. I didn't debunk it, but I basically just said, listen, like if you want to pay your mortgage off in 7 years, there's plenty of ways to do it. And it's not necessarily like a HELOC is some magic answer. Okay, greater than 10,000 views. I'm just looking real quick on the channel. How to pay off a mortgage faster. The truth about velocity banking. This one was fun because like people just, they're so gung-ho about this velocity banking concept. I don't know. I think it's kind of silly. How do I post something because I don't think you guys can necessarily, when I post something like this, can you guys copy and paste it? It's just the link to my video. It's called How to Pay Off Mortgage Faster, the truth about velocity banking. So I don't know. Long-winded way of saying I'm not a big fan of that, because here's my opinion. You want to pay off your first mortgage fast and your goal is to have your mortgage paid off in 7 years, chunk extra payments towards your principal and you'll pay off your mortgage in 7 years. If you want to be super fancy and get a Heloc for 20 grand, throw the 20 grand on your mortgage, then slowly chop down that Heloc, and then throw the 20 grand at the mortgage, slowly chop down the Heloc, throw your 20 grand at the mortgage. You're doing the same stuff. It's the same thing. People are like, no, it's the magic. It's the magic of the Heloc, because you're going to put all your income in there and then you're going to do this and do that. Like, all that strategy is you've got $7,000 a month in income and you've got $4,500 a month in debts. That extra $2,500 is being applied to your principal every single month. Well, forget all the Heloc and forget the extra risk of having a home equity line of credit that you might get stuck with 20, 30, 40,000 in debt on, and it can adjust, and just take those extra principal payments and apply it towards your principal. And my thing is too, people are like, well, then gosh, all your equity is just tied up. You're just making those extra payments towards the principal. Then go get a Heloc if your equity is tied up and now you need 15 grand. But to do it up front, I don't know. Like, the math to me just doesn't pencil. I've done it before, and it's like you do all this work, you do a second, you do a Heloc, and you save $722 over the course of 7 years. No thanks. All right, Chief Woodenhead. I bought a house with 2 unpermitted rooms. Yes, they were disclosed to me. Pros and cons. Inspector said good build quality. I guess the con would be that if they're unpermitted, you might have an issue with appraised value at a later date. If the appraiser, calls out, hey, these are unpermitted, and doesn't, provide the extra value to them. But my thought is that if you got a good deal on it because they were unpermitted, maybe you could spend the money, get them permitted, and then, it could be used for an appraisal that's going to add to the value. But then taxes might go up. I guess it depends too. Like, if you're going to live there for the next 30 years and you have no plan of selling or refinancing, then no harm, no foul. Hopefully you got a deal. That would be the pro. I bought a property in New York with an FHA 3.5, 2012. Oh my gosh, of course. You could definitely. Oh, I see what you're saying. So I was going to say, like, for sure you've got enough equity to remove the PMI. Like, get on the phone now, call somebody and refinance. Here's what you got to figure out, Jennifer, is FHA loans that are written now, you can't remove the PMI. It's just, it stays on there for life of the loan. But for you, who originated a loan way back in 2012, that PMI should fall off. And so contact the servicer, ask them whether it's going to fall off in year 10. I'm not sure the exact number of months. If it's after 120 months, it falls off. But you are correct in that the old FHA loans that were written, I think, prior to 17 or prior to 16, the MI should fall off. So you're going to call the servicer, ask them what needs to be done to remove it. But here's the thing. If you've got a loan for 2012 where you got a 4.75 FHA with PMI and you qualify for a refinance, reach out to a mortgage broker and say, hey, I'd like to refinance from 4.75 down to 3%, remove mortgage insurance, and just do it all in one thing, because you're going to save a bunch of money, lowering the rate as well. I am not licensed in Florida, but what I can do is give you a link, greatmortgagebroker.com. You go there, you fill out 6 quick questions. This is going to tie into, where'd it go? Caden filled out this quick link, got connected with U Mortgage. They will He filled out the link and then they call you, see how they can help. Depending on where you're at, what state you're in, it's going to connect you with a broker who's in your state. Somebody who I like and trust is going to take good care of you. I've got nothing but good feedback. If they ever don't provide great service, they're going to be in big trouble with Matt the Mortgage Guy. So my reputation's on the line. Fill out that link, if you go to mattthemortgageguy.com, there's a not in California. You click that link, that brings you to the same place, or greatmortgagebroker.com. Same. What are you seeing in 30-year fixed jumbo? Very good credit range. My guess is you're asking for what am I seeing rate wise? Jumbo loans at most lenders I work with who are getting loans done in a timely fashion, which everybody wants. Not many sellers are willing to wait. Rates on a jumbo loan, depending. I've got jumbo products that are 10% down, 15% down. But if you're putting, say, 20 or 25% down, you're probably mid threes, low threes if you don't mind paying a little bit. But let's say you're going to pay 1.5 milli and put 20% down. 1.5 milli. And you're buying in LA County. I'll get you something. I'll get you something right now. Oh, better than I thought. So 3 1/4 is no points. If you want to pay a point, you can get it to 299. It's actually less than a point. It's about 0.9 points. So 299 to 3 1/4, $1.5 million purchase, 20% down. The thing that I'm seeing a lot in California is a lot of 10 and 15% down jumbo. Same product, slightly higher rate. Good news is there's no mortgage insurance. And so that is a very popular product. Can I get 2 VA loans, one in Ohio and one in Florida? Yeah, and it's pretty common if you're a veteran who's moving, because veterans tend to move, depending on where they're stationed and whatnot. You can own that house in Ohio. You relocate to Florida. The VA loan's got to be used for your primary residence, so it's got to be the state you're living in. Like, let's say you're living and working in Florida, you want to buy something in Ohio that's, you got family there or something. You're not really living there, you're going to have trouble getting it. But if you're relocating, the only thing you need to check is contact a lender and make sure you've got eligibility. And your eligibility can be pulled fairly easily from any lender. And, depending on the loan size of your current loan and the loan size of the loan you're trying to buy, may or may not have enough eligibility to do 100% financing on both of them. But really easy process to go through with the lender to find out if you qualify. It's certainly possible. And I've got plenty of veteran clients who've got houses somewhere they used to be stationed, and now they came out to California and they bought a new house here. All right. Dream Vision Productions. Thanks for joining. Chapter 7, bankruptcy discharge, June 21st. Besides building credit, what steps should I be taking for the next 24 months? And what issues, hurdles will I possibly have then? I mean, I think the credit thing is the most important. You also want to save for a down payment, because depending on how quickly your credit rebuilds, if your credit is dragged down for 12, 18, 24 months because of the BK, and let's say you only get back to 660 or 680 credit score, you're going to be paying higher mortgage insurance with the lower down payments, with 3% down, 5% down. So you might want to try to save up money and put 10% down, lower your mortgage insurance. Because, for instance, if you have a 660 credit score and you're trying to put 3% down on a conventional loan, your mortgage insurance is going to be very high versus 10% down where it's a lot more affordable. Snake went under picture. Oh man, someone's messing with me or something. That's good though. That's good though. Made me look. When is a good time frame to lock in a rate in new construction? I was told there was some kind of fee difference. Yeah, so try to simplify this. Let's say that we were looking at your loan. I mean, I could do a real life example. I'm going to pull some pricing up right now. And I can't pull all the, oh, you know what I'll do? Check this out. All right, stand by. This is going to be helpful for people. Home Point, a second favorite lender, Home Point for business. I'm going to log in. I'm going to show you 15, 30, 45, 60-day pricing. This is going to be helpful. Stay tuned, everybody. I think you're going to like it. 37 likes. Once I get to 40 likes, I'm going to show you guys. Just kidding. I'm going to show you regardless. But it would be nice to get to 40 likes. It would be very kind of you. Okay, quick pricer. We are going to do conventional purchase. 25% down. $650 purchase price. Just put out some random stuff. Let me see if I remember how to zoom in. So here is what it looks like on my end as a lender. This is a purchase. All right. Share screen. Boom, boom, boom. Oh, that's too small, huh? Okay, so if you can see this right here, 2.75. This is, if I scroll up, see these days, 15-day, 30-day, 45-day. That's the number of days that we can lock it. And then there's the expiration date, right? So 15 days, 30 days, 45, 60, 75, 90. Now we go down here and we scroll down and say we're looking at 30-day locks. 2.75 costs $1,700. Or if we took a 2.875, we'd get a $1,700 credit. Now, if we move to a 45-day lock, that same 2.75 costs about $800 more. Or move to a 60-day lock, it costs another $500 more than that. And the credit at 2.875 was $1,750 here. It goes down to $1,000. It goes down to $400. So as you can see, it's more expensive to lock it out for a longer amount of time because it's more risk to the lender, or the lender's guaranteeing that rate for all the way to the end of August by doing it for 60 days. So here's the thing: you're buying a new build, and like you said, the 15-day lock versus the 60-day lock is different. If we were closing this thing in 15 days, they're only guaranteeing this for 15 days. You can get 2.75. It only costs you $1,000. If you would try to do it for 60 days, it would cost you $3,000. So what you have to determine, and this is near impossible, is let's say this was your loan. I think I typed in 650,000 with 25% down. So this is the principal and interest payment over here. Like, what rate would you like to lock? And the rate you can change a later date, but you can't change like the lock period. Maybe you're like, you know what? I want the certainty, the 2.875. I'm going to get a $448 credit. Boom. Lock it. Not worry about it. If you think that rates might stay the same, you might get 30 days away and it'll be $1,300 better. But this is if rates are exactly the same 30 days from now. If I was you and this was me, and you're 60 days from this thing being done, slap that lock right there. Bam. Lock it. Right? That's what I would do. So hopefully that was helpful. Little quick lesson in rate sheets. All right. Way too early prediction on housing market and rates for mid 2023. Oh, yeah. June of 2023 for sure. Rates are going to be 4.375 and prices versus today are going to be about 5% higher than they are today. Because what's going to happen is 2022, we're going to see 3 to 4% appreciation. 2023 is going to be even slower, 1 to 2% appreciation. So today versus then, only a 5% uptick, but rates at 4.375, a lot less affordable than they are today. I got no idea, man. But that right there, if I'm right, I'm going to clip this little piece. I'm going to tell people like, look, I told Dream Vision back in 2021. Who friggin' knows, bro? It's a guess, though. Can a lender just change lender's credit after I sign the loan estimate, as in just a few hours after signing? They said they made a mistake because I switched to cash out from rate and term, which is not true. You might have been doing cash out the whole time, but the lender screwed up. I honestly would not. I mean, I can't say I've never done it. I can't say I've never disclosed something as a single family. It was actually a condo. Disclosed something as a rate and term, which is actually a cash out. Those mistakes happen, and as much as I'm not trusting of all people at all times, this sounds to me like it could have been an honest mistake. And if you like and trust that lender, maybe it was an honest mistake. And maybe they sent out initial disclosures and you're like, hey, here's a $5,000 lender credit. And then they're like, oh, shoot, it's a cash out refinance, only $2,000 lender credit. Then it might just well be that they truthfully made a mistake. The link sent you directly to the video. Oh, okay, cool. That link from earlier for that Heloc one. Yeah, check that out later. It's a good watch. What's up, Miguel? 3% down. You're about 3%, give or take. Depending on the loan size. Some lenders are going to not give the smokingest rates to the itsy bitsy loan sizes. But let's say you're buying something for $600. You got great credit, like you says. You're putting 3% down. Purchasing a home. I'm gonna get you that right now. Stand by. This is fun. I got nothing to hide, nothing to sell. Just giving you what happened. I had to click first time home buyer to get that pricing with 3% down. Come on. Oh, too big of a loan. Not a conforming loan. Quick shout out to my buddy Joey. My kid just texted me that his buddy hit a bomb. So their all-star team is up 3-0. I checked that when I was doing the pricing. Just happened to glance at my phone. My kid will let me know. College Glen All-Stars up 3-0 versus Rosemont. Let's go. Okay, lender paid MI, monthly MI. just as I suspected, 3.0, 3%. 3% for all intents and purposes. With 3% down, it's a rate you're going to see. So if you wanted to buy it down to 2.875, I wouldn't advise it more than a half a point cost. And then it's really expensive for 2.75. So yeah, right about 3%. That's what you should be getting. If somebody's telling you 3.25 or higher, you've done talked to the wrong mortgage professional. Wouldn't be the first time. I can't tell you this is illegal because, generally speaking, loan estimates can change, especially before the loan is locked. The good news is, I don't know if this is a purchase or it's a cash out refi, right? Cash out refinance, you can cancel. So if for whatever reason you don't trust the lender, which again, I think it's just a matter of an honest mistake. I believe you might have sent me the estimate. If you want to send it to me, just because they disclose something up front doesn't mean they're bound to it. If it was an honest mistake, like, hey, this was for a rate and term refinance, you're doing a cash out. A cash out is only this much credit. Then, you might just be having to decide, do I still want to proceed or not? And that's, a decision you can make. You're not bound to anything. Lender doesn't necessarily have to, deliver on a mistaken loan estimate they sent out the first time. All right. Yeah, I was asking about that. 2 hoes and a console. All right. It makes sense. Video game channel. Cool. Got my offer accepted over the weekend on a coming soon listing. Went up Thursday, got pics, video, drove by the place, put the offer. Sweet. In Thursday night, they accepted it Friday afternoon, and we open escrow today. Keep your eyes on coming soon. Nice. Good advice. I appreciate you sharing that with everybody. Just goes to show you we've all got a chance. So you're saying there's a chance. Example of somebody winning, and I like to hear that. So anybody else who's out there, I've already seen it. I've already felt it. So I can say with absolute certainty in the next month or two, it is going to be easier on buyers. I guarantee it. Demand has waned just a tad. Supply is starting to creep up just a tad. Some of these sellers that are unrealistic. I've heard from multiple people who thought that their houses were going to sell really fast and are like, man, I ain't got an offer yet. What's going on? That's going to start happening. Then you get a little bit of fear in them sellers and you'll have a little bit of leverage as buyers. And as a mortgage broker, I'm on the buy side. That's my team. You guys are my team as buyers. So I'm rooting for the buy side. I'm doing all I can. It's still super competitive in a lot of markets. So don't get me wrong that you think I'm saying like all of a sudden it's like we got all the leverage, we're in charge. Not even close to the case. But what I will say is that starting to shift a little bit, not having to go 100,000 above asking and give firstborn and everything else. So it's going to be a little bit easier, which is a welcome thing for buyers everywhere. No worries, man. Happy to help. How easy is it to loan after turning primary residence to rental? It's all math. And so it makes sense to me. You're basically going to move out of your primary. That's going to become your rental. And you're going to use your rental to offset the mortgage. But here's the thing. Offsetting doesn't necessarily mean like now you qualify for brand new, because people misunderstand this. And I got to write it down so I can understand it myself. Let's say your income, let's just say your mortgage payment's $2,000 and your rent that you're going to be able to charge is $2,400. Well, we can only use 75% of that. So you'll say, okay, 75% of the 2,400 is 1,800. So you've got 1,800 in rental income, 2,000 in a mortgage. It doesn't necessarily offset it because you got to think about debt to income ratio. That 2,000 in debt, and that 1,800 in rental income, it's like more than 100%, right? And so if you've got 5,000 in income and you're going to be able to add that $1,800 in rental income, your departing residence, right? Now you've got $6,800 on the income side. 45% of that 6,800, which is about max DTI, we'll just use that number, is $3,060. So you've already got a $2,000 mortgage. You can only add a $1,060 mortgage and qualify. All right, let's rewind that. You're probably not trying to buy your second house with $5,000 a month in income. So let's make it $10,000 a month in income. Now you've got $1,800 in rental income, departing residence. So now our total is $11,800. And our new magic number to stay under is 45% of $11,800, which is that $5,310? $5,310. So you got a $2,000 mortgage, a $500 car payment, and your new mortgage has got to be $2,810 or less to keep that debt to income ratio under 45%. Hopefully that made sense. Hopefully you followed that. But it's not as easy as like, oh, those offset, let's start fresh. It's current mortgage plus new mortgage plus all the debts on the debt side that can exceed about 45% of total income plus whatever income you can use from the departing residence. It is true what they say, anything is negotiable in escrow regardless of what the contract says. Kind of. I mean, I don't want to steer you too wrong, but I mean, I've seen all kinds of stuff. I've seen like, contracts that say like absolutely no repairs are going to be done. And then they negotiate $1,500 in credit for something that got called out on repairs. So yeah, it's not necessarily, in stone what the contract says. And shoot, what's the worst that can happen? You ask for it and they say no. I'd say ask for it. All right, 5% down with 710 credit score, 348.2. I'm guessing this is a pricer. This is a pricer. Everybody likes the pricer, right? Why not? Be honest about what the price is. 95%. All right, you're purchasing. I'm using 348.2 as the purchase price. 5% down. Here's the thing. When you're doing 5% down, not only do you want to look at the credit or come on, brain. Not only do you want to look at the rate, you want to look at the mortgage insurance because the mortgage insurance is going to vary lender to lender. So for example, on this exact scenario with your exact credit score, I see a 2.947 as the rate with no points being paid. If you wanted to buy it down, you could. You get down to 2% if you want to pay 5 points, but you would never do that. 2.947, a 0.22 MI factor, so $60 a month in mortgage insurance. What you might find at other lenders, because they're all different, is a same rate, a similar rate, but $95 a month in mortgage insurance. If you're paying $95 a month in mortgage insurance, it's almost like paying a quarter higher in rate because it's $35 more. So watch out. Let's say that a lender said 2.875, but $95 a month in mortgage insurance. This loan will be better. 2.94, $60 a month in mortgage insurance. So look at both those things and look at fees and all that there. What states are you licensed to do business in? Would love to find another Matt in Philly. Dude, PA is where the Hus bus is at, I think. Let's see. Mortgage. Let me see. I'm pretty sure these guys, oh yeah. Go to the hussyteam.com and hop on the Hus bus to home ownership. These guys are the best. I went out to Philly because there's a broker organization out there. And I met Mr. Jeremy Hussey. Great friggin' dude. If you go to the Hussey, HUSSEY team.com, connect with him and say Matt the Mortgage Guy sent you. They'll take good care of you for sure. On their website, team@thehusseyteam.com, phone number. They're over in Conshohocken, Pennsylvania. They'll take good care of you. If you filled out my my form at greatmortgagebroker.com, we connected with U Mortgage. They're also based in Philly. So either way, you're covered. All right. Best of luck to you. Let me know how that goes. Who you connect with out in Philly. Or out in Pennsylvania, I should say. Not necessarily Philly. Looking to buy a second property. Wife is not on primary residence mortgage, but named on the deed. When you say, can she get a primary loan still? You can only get a primary loan if you're going to live there. If you're not going to live there, that's mortgage fraud. That's bad. Lenders will find out. They won't lend to you. They'll put you on the naughty list. So why can't I think of what an STR is? STR. I've seen that before, but it's late on a Monday. Been working all day. So STR. Someone help me out there. All right. What else we got? I'm headed to closing. I need a car. I have no debt. Do I have to wait? They said they will do a soft check. Yes, do not buy a car when you're headed to closing. Walk to the closing, Anthony Taylor. Take a bike. Do whatever you can to not purchase a car while you're headed to closing. And, you could talk to your lender. Truth be told, if you've got good income and no debt and you qualify with that, here's the problem. Even if you qualify with the car, you're going to buy it. They're going to do a soft check. What's this going on? What's the new debt? Provide us all the paperwork from your new car loan, the monthly payment, submit it back to underwriting. Underwriting is going to review it. Now we're going to draw a new, it's going to delay your closing by a week. So maybe you delay your car buying by a couple days, get this puppy closed, and then go buy that car. For the time being, look up Turo, Turo. You can rent a car for like $80 a day from somebody else. Ride that whip for a week, and it's going to save you a bunch of time and headache from having the deal back into underwriting. And just, it could get messy. It's not necessarily always going to be, but it could. You just don't want to risk it. Lynn, thanks for joining. Is it true there's a grant included in your conventional loan? A buyer's not able to buy down the rate? Oh, it depends. And grants are, state by state specific. I'm assuming you're talking about home buyer, like first time buyer grants or something like that, down payment grants. Some of those grants you are able to buy down the rate, but they're all different. And every state has multiple programs, multiple grants. And so I would talk to whoever you're working with on that specific grant program and what the rules are and all that stuff. Hi, Matt. When they do review conventional loan limits to support an increased limit. Yeah, you're not going to know until the end of the year. It's probably going to go up. It has to do with the median house price. And we know that's gone up, right? And so it's going to increase for like literally every county in California, but you're going to have to wait until, we get those numbers for San Bernardino. I think it's sometime in December or maybe even earlier, like late November, we'll get those updated numbers and it'll be effective. What happens is they'll start honoring those for loans closed in December because they know they're just going to sell them to Fannie and Freddie in January once the loan limits are up. So look out for those. Those will go up. My guess is they'll go up somewhere between 5 and 7%. So what's San Bernardino County currently? San Bernardino County loan limits 2021. 548,250. I'm gonna go on the high side. Let's say they go up 7%, 586. That's my guess right here on record. 2022, 586,725. Final answer. I mean, you could sell it right away if you wanted to, but all the costs associated with it, that would be the silly part. I mean, it's not a silly question, but things change. People do it all the time where they bought a house and things change. Life changes. I got a job across the country. I don't want to keep it as a rental. They'll list it and sell it. So there's no rule. Sometimes the lender will get a buyback if it's sold within 6 months, but it's part of the business. I've had people where I do a refinance for them and then 2 months later they sell. They didn't plan to, but things changed and they decided to sell. And then we get a buyback where we have to refund any commissions to the lender, but it's part of the business. I'm not mad at it because things change, things happen. People, are not purposely doing it because they paid for the refinance. All right. I'm trying to find what this is a response to. I got short-term memory loss. Don't know if that makes sense. Yes. What did I say? Did I say something good? Okay. No, man, all good. Hopefully I made sense. Hopefully you learned something. Not bad. 2.9 something percent, under 3% on a 30-year fix. That's better than not bad. Rates subject to change daily. So yeah. Any advice for where to get mortgage insurance? Well, if you're talking about mortgage insurance, then you work with a broker who brokers your loan to a large wholesale lender that gets you really discounted mortgage insurance. If you're talking about like homeowners insurance, where like hazard insurance, then you also talk to a broker, just an insurance broker to get that. But it's not something you're necessarily shopping for separate. The lender that you work with is going to find you the best mortgage insurance rate. Can you find one lender for Jacksonville, Florida, if possible? Yeah, I guess if you filled out the form and for whatever reason you get contacted and they're not a good fit, or you just want a second opinion, just shoot me an email, matt@mattthemortgageguy.com. I will look through my broker Excel spreadsheet to see if I have a specific broker in that area. But in general, I created that greatmortgagebroker.com to be able to funnel folks. You're in Florida, here's someone who can help you out. You're in Texas, here's someone who can help you out. Some of the lenders I work with are nationwide, so they can handle most of it. And they're always going to offer you best rate, best terms, best service. And I know them personally, so I like them and trust them to take good care of you. Is it better to get a loan with a broker or a bank? 99% of the time, it's better with a broker. Faster, cheaper, better service. And, I can say that with absolute certainty. Banks are good at some things. Mortgage usually isn't their strong suit. I mean, I bet you have bankers that would admit that, right? And there's different ways to get a loan. There's a bank, there's a direct lender, there's a broker, and there's fintech companies, online companies. I'm a big believer in brokers and direct lenders. That all day, every day, that's all they do is lending. Fintech companies might do like, technology really well, but they're going to have call center workers that don't know what they're talking about. Banks, they want your deposits. They want credit cards. They want business accounts. They want business lines of credit. When it comes to mortgages, they're just slow. They're more expensive. Their processes and their systems are antiquated and old. They're just like, it's terrible. I challenge anyone in banking to find me a bank that's a real well-oiled machine that closes loans fast and does them, at a price that is even ballpark what a broker can offer. So that's my 2 cents. I currently finished 203 construction on 3-family property. What LTV do I need and what are the rates? If it's an investment, so you're not living there, then 75%. You can do a rate and term refinance, because I'm guessing that FHA loan has mortgage insurance and probably not the best rate on a 203K. So 75% is the LTV you're looking for a refi. Short-term rental. I knew that. Yeah, if it's a short-term rental, it's not your wife's primary. So no can do, Tariq. Sorry. I ain't down with that. I ain't not down with the mortgage fraud. I worked too hard for too long to create too good of a business. So yeah, you want to buy that thing as an investment property, or if you guys are moving into it, buy it as her primary and then, live there for a year. If you decide to move out and create a short-term rental, then no harm, no foul. Hey, I'm back. Good to see you back. This is a question that I answered in a recent video I did talking about, like, should you buy points? And this information alone won't be able to answer it, because here's what you got to do. You got to look at the 2.75 and look at the 2.99 and just rough math, rough. 275, let's call it, or let's not even assign a number to it. Let's just say the difference between the two is $40 in payment. And let's say that 1 point, or we don't even know how many points, right? Let's say the difference between 2.99 and 2.75 is 1 point cost. Your loan is $355,000. So it's $3,550. All you got to do is look at the difference in payment and the $3,500 cost. And let's just call the difference in payment $40. $3,550 it cost you, divided by $40. That's an 88-month break even. 7+ years to break even on that point you paid up front. I wouldn't do it. Not $3,500 in today's money to save $40 a month in future dollars that are worth less. Probably. Inflation be coming. So that's what you do. You take the cost, which is the points, and here you didn't specify, but let's call it 1 point. Divide it by the monthly savings, because 2.75 versus 2.99, the payment's less at a lower rate. How much less? $40. And so do the math, find out what the break even is. If it's more than 5 years, I generally don't advise it. In this case, where I just made a scenario where it's $3,500 in costs and $40 per month, that was an 88-month break even. I did not approve. I gave that a no, Scott. What is the minimum credit score to do a cash out refinance on an existing mortgage? I mean, there's some lenders that will do a cash out FHA on some dog doo-doo credit. Dog doo-doo translates to, in the 500s. So the better question is probably like, does it make sense, right? A lot of people might come to me and they're trying to do a refinance. Their credit score is 590, and especially on a cash out. Cash out's always going to be more expensive than a rate and term. If there's points involved, if the rate is terrible, if all these things just, the terms are not going to be as good if you've got challenged credit. And so you got to look at that and weigh it. One I just recently looked at was someone's like, hey, I want to do a cash out refinance to pull some money out, do some repairs. And we looked at it like it was going to be so expensive to do the refinance. They're only going to be able to get $10,000 in cash out. And in that case, it's like, no way you're going to take a higher rate. You're going to add mortgage insurance. You're going to do all that for $10,000. Like, I would not let them do it. I wouldn't write that mortgage. I would refuse. And so that's the stuff you want to look at. For a short-term rental, is it considered a second property? Does it have to be an investment property loan? For sure, it's an investment property. Second property or second home is something that you're going to spend time in each year. You're going to buy a beach house. You're going to buy a house to ski at or something. And so those are homes that you're not renting. Those are second homes or homes that's like, that's your second home. That's where you go spend the summers and 4 weeks every winter with the family. Generally, that's about what it is. Open escrow today, Ventura, California. Thanks for all the great info. Got a great lender and a great team. Awesome. That's good to hear. People are getting into contract more and more. It's opening up. Hopefully you're working with it. Yeah, great mortgage broker down there in Ventura, California. Congrats on getting into contract. Love to hear it. Love to hear folks. 3.5% interest and down FHA with $10K down payment assistance. $3.25 rate, no DPA. 3.5 conventional, 3% down. I mean, there's a lot of variables here, VQuez. Lots of variables. Down payment assistance is generally not the jam. Is this $10,000 being tacked on the back of the loan? Is there fees involved with the down payment assistance program? And then 3.25 rate, no DPA, 3.5% down. So this is another FHA, I'm guessing. So you want to know your credit score. Your credit's, if the conventional 3% down is 3.5%, it means your credit must be not so sharp, because we just priced one for somebody else and it was 2.9%. A lot of variables there. I steer clear of down payment assistance. It's just generally not the jam. Linda Fernandez, great question. Broker versus direct lender. I used to be a direct lender. I'm now a broker. Having made the change, I believe that the broker is the better place for the consumer, but a big but. Direct lenders do a great job. I got plenty of friends who are direct lenders. I know plenty of direct lenders that have streamlined systems that make the process smooth and easy. I tend to believe, and sometimes there might even be proof in the pudding, that brokers have lower margins, offer better rates and terms. But, there's some direct lenders who are fairly sharp, run on thin margins and offer great as well. So, I'd rather say that I'm on team broker and direct lender versus banks and fintech companies. Fintech companies, I don't really care for because they don't serve the client at all. They are, built for volume and built to just literally smile and dial and get as many people in the pipeline as possible. And I've never seen a fintech company that has highly trained, highly knowledgeable loan officers giving good advice. It's just call center folks who are trained to hit quotas and get people, moving down their assembly line with little regard for any planning, right? And so if you don't want anybody to give you good advice on how to structure a loan, what it might be, what might be your best option for whatever reason or not, then a fintech company is going to offer you a discount because there's just not much advising at all, right? Mortgage brokers, direct lenders, they're all day, every day, all they do is loans, and they're high level advisors. The good ones are good and the bad ones are bad. That's another piece of advice I want to give people is like the best direct lender versus the worst broker is going to be light years ahead. The best broker versus the worst direct lender, light years ahead. So like within each channel, you're going to have good and bad, right? And somebody who's all day, every day, 50, 60, 70 hours a week, high level team that's high level trained to give great mortgage advice is what you're looking for, not necessarily like, one channel or another, even though I'm biased, right? Like I believe the broker channel is the best place for the consumer to get a loan. Better, cheaper, faster. The end. That's a good question. I was afraid you're going to ask me that. You know what? Because I was thinking to myself, it's 75. I'm going to go out on a limb and just say 75. You could do 80% if it was a duplex owner occupied, but I'm almost certain that a 3-unit owner occ is still going to be 75. But I'm gonna check for you. Stand by. June pack. Primary residence, 3 units, 94509. That's what I'm gonna say. Your zip code, Contra Costa County. I just feel like you're in Contra Costa. 675. No way you're gonna find a threeplex for 675 there, but why not? Refinance, rate and term. I'm thinking it is gonna be big bucks, no whammies. Oh, yes, you can go to 80. I was wrong. Good thing I checked. You can get smoking rates. 3-unit rate and term, 80%. Yep. If you're owner occupying it, you're going to 80. See how much I learn every day? You're going to 80 and you can get like a 3.25 on a 3-unit with no points. That's pretty good. Ooh, what's the interest rate for investment properties? Low. I'll give you this. 25% down, great credit, about 3.5 with no points. There's a lot of variables there, right? But that's the basics. The basics, about 3.5%. If it's a single family. All right, I'll ask my lender for a cash out refinance upon getting out of forbearance. I have $400,000 equity and good credit. Want $100K cash out. Worst thing they can say is, how about no, Scott? Yeah, don't ask. I mean, the lender that's doing the servicing is 100% going to tell you no. They're not going to do a cash out loan modification for you. But once you exit forbearance, if you qualify, you can try to get a cash out refinance. A caveat that people should know is that once you've entered and exited forbearance and you've got $22,000, $28,000, whatever that balance is that you owe, whether you consolidate that with your first or whatever you do, it's considered a cash out refinance. And so you might as well, if you've got a ton of equity and are going to consolidate it, take extra cash if you can use it in some way. So, so yeah, that's that. Best of luck to you. What is property tax gain? Oh, property gain tax. Property gain tax? Like if you buy a house and then sell it, then you've got You're paying capital gains on your property? Is that what you mean? Let us know, Zeta. Good to see you here. Long-time follower, long-time subscriber. Zeta Willingham. Thank you for being here. I don't know property tax gain law. Oh man, this might be something new. Oh yeah, this sounds like it's just capital gains. Like you bought a house and then you sold a house and you're going to pay taxes on it. The good news is if it's your primary residence, let's say Zeta, you bought your primary residence 10 years ago and you paid $300,000. If you sell it for $525,000, you're exempt from paying property taxes up to $250,000. If you're married, you can combine yours and your spouse's to be exempt up to $500,000. If it's an investment property, there's no exemption. You just pay the capital gains. But I think that's what you're alluding to. So hopefully that helps. The difference between your purchase price and the sale price, you can do some stuff like write off improvements you've made and whatnot, but you're going to pay capital gains on the difference between what you bought it for, what you sell it for, unless it's your primary, and then you have that exemption. How do you evict a tenant? I tried turnkey at $7K, zero success. Any great attorneys you have used? You're in Temecula. I know great real estate attorneys in Northern California. I don't know about Temecula. Maybe Jeb Smith down in SoCal knows some great real estate attorneys. I had this conversation with a realtor today where I said, she's the agent on a property that's got tenants in it. And so I've got buyers who are buying it. She's like, I think it's going to be hard to get them out. They just extended the eviction moratorium. And I was like, yeah, just offer them cash for keys. And like you have seen, Lewis offering $7,000. These tenants said no to 10 grand. And so it's tough, man. It's tough to get people. I mean, for the people, I understand. Like it's going to be hard for them to find a replacement. So they don't necessarily want to take 7 grand or 10 grand if they don't know where they're going to move to. So best of luck to you, man. I don't know what you do unless you've got like just cause, which you can. I mean, people think that just because there's an eviction moratorium, you can't evict people. If they can't show that they've been affected by COVID, they're just not paying because they're dirtbags, you can still evict them. I mean, I had a successful eviction that was it the end of last year, beginning of this year? I've got tenants who are behind who are great people. They're trying to make it work. They're trying to pay what they can. They're going to pay a portion of their rent, and I'm working with them, and they're great. I've got other tenants who are complete dirtbags, starting fights, fighting with property management, fighting with other tenants, still getting paid 100% of what they got paid pre-COVID, just choosing not to pay. Them done got evicted. They even tried to argue with the judge, and the judge said, you gone. All right, VQuez, 704 mid score. I still think you get better than 3.5% conventional. I'd probably go conventional though. You'd have to look at the mortgage insurance too. So look at the rate and mortgage insurance. Put the FHA and the conventional side by side. Depending on what state you're in, like I don't know what the terms are of the down payment assistance. So, yeah, you want to get the terms of the DPA before you sign on the dotted line. I've got people that use down payment assistance in 19 and 20. They're contacting me now. I can't refinance them because they got a second loan, a third loan. We can't pay them all off and refinance them at low rates. So they're stuck, and it really sucks. So be careful, please. Can I get a loan where the property will be under a family trust? You are going to have to be a signer where you're personally liable for it. But if it's already vested in a trust, you can close it and it can still be vested in the family trust. Sure. If it's not vested in the trust yet, just close and then do a grant deed either from your trust attorney or from a deed service that's going to slap it into that family trust. But yeah, you can hold a loan. You're going to be personally liable for the loan. The loan's not going to be like the family trust is the one who's liable for it. You are still personally liable for it, but you can own the property in the family trust. And that's super common. With the new construction, is it okay to shop lenders nearer to projected closing date? Yeah. Get people to pull your credit. It's not going to hurt you that bad. And really, like, it's common, right? The builder's lender just forces you to get pre-approved with them. So you're pre-approved with them, but 60 days out, you get a second and third opinion. All good in the hood. People think that pulling your credit's going to kill your credit. 5 points. If you can't afford 5 points, if you're 702, you think it might take you to 697, then, it might be tough. But if you're 775, you got 5 points to spare. You're good. If you renting now and can buy a home from another state, a second home, I don't think so. I think the lender's gonna. That's a good question. Can you buy a second home without a first home? Second home. And keep in mind that a second home is not like in the middle of a city. A second home for lenders' purposes has to be like a destination type place where you would have a second home. But I don't think you can. I think that would be considered a rental property. Joe, my dude. I said single family residence. Okay, so 3-unit property. And this is an investment property, right? Okay, investment, 3-unit. You got to tell me the loan to value. You're buying this? You're refining this? I'll give you a little price check, right? I'm going to assume investment property, 3-unit, and 790 credit score. I don't know if it's purchase or investment. I mean, I'm purchase or refi. I'll go purchase first, and I'll tell you where we at. Because that sounds mighty expensive. Mighty holy crap. Oh my gosh. I just priced it 25% down, 790 credit score, investment property, 3-unit, and for less than a point, you got 3.625. I don't know where you're getting this rate, 4.4, but good load. That's high. That's like Snoop. I've signed paperwork already with lender, but I still haven't paid the appraisal. Gave the deed company the lender's info. Oh man, this is great. Are you in contract to purchase? The first company does have better customer service communication, but I want to stray it over to this second company. They offer me a little bit better rate. I don't know if they can close. I don't know if they can deliver on what they promised, but that better rate sure is tempting. If you're in contract to buy a house, this better be a big difference. If this is like $1,000 difference on the biggest purchase of your life, and you're trying to jump ship and work with a low budget fintech company that's just putting you in a process, the only thing you can talk to is a call center person, bless you for taking that chance for being a gambler, because that is just a very high risk gamble that I would not personally take. So yeah, think long and hard before switching lenders is my honest opinion. More often than not, the lender who's got your full file, who's got you rolling, even if I'm the second lender in this scenario, I don't necessarily want to take something from somebody midstream. You've already started it. They've already ordered the appraisal. The answer to your question is you could switch. Here's the problem. If it's a purchase, that lender could let all parties know, hey, they switched lenders. That could freak the sellers out. The sellers could be like, we're canceling. We're not going to have this thing fall apart because they're wishy-washy, changing lenders and doing all kinds of stuff. But I would think twice. Eddie True, thanks for joining. Good to see you. Is there a company that does cash out refi above 80? Yeah, there probably is. There's probably some non-QM lenders that go to 90%. It's risky. The terms are a lot worse. Sometimes it might be better just go to 80% with a conventional loan and then do a home equity line up to 90%, which a lot of home equity line of credit lenders will do. But be careful. Higher you go, the more risk you're taking. You're in New Jersey. GreatMortgageBroker.com. That's where you connect with somebody I know in New Jersey who's going to help you out. Is there a loan with no closing costs on investment property? I'm willing to pay higher interest rate. Sure. I've got lenders where I could, take you up to 5.25, offer you some closing cost credits. You just got to be careful that it's only going to make sense to you to do it that way if you're planning on selling it within 2 to 3 years. If you're going to hold it for the long term, you're going to pay 4.75 instead of, a 4% or 3.625, whatever the rate is without paying points, then it's going to be more costly in the long run, right? I heard recently, JJ, I heard that you only get to do that once in your life. That tax exemption for selling your primary and not having capital gains. I didn't know that. Somebody confirmed that for me. Capital gains exemption for primary residence. If anybody missed it from earlier, you can buy a house, it can go up 200,000, you can sell it, and you're exempt from paying capital gains if it's your primary residence for 2 of the last 5 years. Up to 250,000 for an individual, up to 500,000 for a couple. JJ saying he did this a year ago. It's my understanding, JJ, that you can only do that once per lifetime. But shoot, if you could do it every 2 years, that'd be sweet. I don't think you can. This is my honest feedback, and I've got nothing to gain or to lose. People are always like, oh, everybody in real estate just thinks real estate's going to go up forever. And you guys are all the same. All you real estate folks, listen up. Nobody on here is like this, but in my comments, I get more haters. That's when you know you've officially made it. Once you get 100,000 views a month or so, the haters come crawling out and they're all telling me that I'm, doing damage to people by the advice I'm giving and all that. I'm set. I do this every Monday for fun. My mortgage business is thriving. No matter what I say or do, it's going to continue to thrive. And I'm not trying to sell an Eskimo ice at a high price. I promise you that. So my honest prediction is that housing is going to slow down, but we're not going to see depreciation. Is that the right word? I don't think houses in 2 years will be cheaper than they are today, because I think that the supply versus demand, like inequality is just too much for us to flip that anytime soon. So if you ask me what I thought about, housing for 2022, 2023, home price appreciation is going to slow down a ton, in my opinion. And in my hope is that it does, right? Because 15% year over year is just, it's too much. Buyers I work with, it's too hard. So if we saw 4 or 5% appreciation in 2022, it would be amazing. If we saw, a fairly flat housing market as far as prices go in 2023, nice. And I think we'll get there. I think we'll get there because I already see a little slowdown in demand. I see an uptick in inventory as things start to open up. More sellers are selling. More people are traveling and maybe not, such a frenzy for buying. And so with that, and with rates ticking up by the end of the year, which is going to quell demand a little bit more, we probably get to a more level and even housing market where 3 to 5% appreciation is healthy and sustainable. Back in 2018, I had some financial problems, so Citibank closed down 4 of my cards and put me into a pay down program, lower the interest rate. I still owe them my $4,000. I asked them for a deal to pay less. Citibank said no. Should I just stop? So probably in collections or something to that effect. It would depend on what your credit said, and I'm not a credit expert per se. I'd probably connect you one if you were a client of mine. But a lot of times when you're paying collections or you're messing with collections or anything's going on with something that's derogatory like collections, it's hurting you more than it's helping you. So maybe you should just stop. I don't know. I'd talk to a credit person though. That's my answer. Okay, 6 investment mortgages under my name. It's not a refi. Okay, if it's a purchase, I'm gonna get you a quote. I'm gonna put under the box that says finance properties, I'm gonna put 7. It's a 25 basis point hit. So it's 3.625 is 1.1 points. 2.2 points for 4 something is outrageous. Are you putting 20% down or no, you're putting 25? Whoever you're working with, they ain't the jam. Here's the thing. With investment property loans, different lenders have done very different things. In 2021, Fannie and Freddie basically said you can't deliver more than 7% of your loans as investment property loans, so send us less of them. Some lenders took that as we're going to stop doing investment property loans, or we're going to put a serious halt to it. How you put a serious halt to loans is you jack up the prices. So not down talking this lender that you're working with, but they do not want investment property loans. They're pricing themselves out of the market. Anybody who does business with them, it's like a contractor who's super busy. And he's like, listen, I'm going to quote something so ridiculous that no one's going to take it. And they go out and they bid on a $50,000 job and they tell you $110,000. Okay, sure. Can you start next week? And they're like, holy crap. I tried to bid so high that nobody took it. He's going to pay me 110. Like, shoot, I'll do it. That's what this lender at 4.4 with 2.2 points is. Is there a contractor who just bid twice as much as the market? And you're like, cool, let's roll. So let me check. Investment property, 3 unit, great credit, 25% down, 7 finance properties, 3,625 with a 1 point cost. I mean, it's just off, bro. It's off. Yeah, check my videos. Check my videos for not new rules, but basically prices increased at some lenders because of the way that Fannie and Freddie said, we want less of these. It happened in Marchish. Type in investment properties on my channel and some videos will come up to that. Oh, Lynn, thank you. Hopefully you find value. Hopefully you're back here every Monday. Continue to ask questions. Continue to, come back for videos. I try to do the best I can to just make it simple. I'm actually creating a course as we speak, Mortgage 101. I just want it to be simple for folks. Mortgage doesn't have to be complicated because it's really not. If a dummy like me can understand it at a high enough level to explain it in simple terms, then anybody can understand it. So I appreciate the kind words. However the heck you stumbled upon it, I appreciate that. Share it with some other people who can stumble upon it as well. Daniel, can you get a refinance without getting an appraisal? The answer is yes. An appraisal waiver, and I made a video on this because I've made a video on 450 different things. An appraisal waiver is when I input all your information into the system. And let's say that you're getting a refinance, you owe $260, your house is worth $540, you got a 762 credit score, and your credit's clean, there's no old derogatories, whatever. This all gets plugged into the system, and the system will spit out. It's based on your credit. It's based on internal information that the system has that says this property in this neighborhood is probably worth this amount. And if everything checks out through the system, they'll grant you a waiver. Because if your house is worth $500 and you're doing a rate and term refinance at $260, an appraisal is not needed. No matter what condition it is, whether you have granite countertops or Formica, like that doesn't matter. It's a make sense deal for the lender, right? And so the system will tell us. And a lot of times people are like, hey, can I ask for an appraisal waiver? Or what do you think about an appraisal waiver? We just plug it in and we see. And really, there might be $1 million home where you're refinancing 220 and the system says no. There's not enough data in there with other appraisals in the area to give them the data they need to feel comfortable. Or, your credit's not as good and the automated system, the algorithm doesn't like it. So, long answer, what I just gave. Short answer, yes. You can refinance without getting an appraisal. Maria, it's not just once in a lifetime? Well, how often can you do it? I had a client tell me they're like, oh, I can only do it once. They was wrong. As long as Maria's right. Just as long as you've lived in the house for 2 of the last 5, then you can do it again and again and again. And that's the rule, JJ. Is you've got to live in it for 2 of the last 5. So like you said, if you just did it, you couldn't go do it until you've lived in that new house for at least 2 years. JJ, if I was to become a mortgage broker, how would I generate business? You would move and shake, talk to as many people as possible and tell them that you're a mortgage broker and that you want to serve people at a very high level and you're going to learn as much as you can about the business. And this is such a tough question. I get this a lot too. People are like, what do I do? What do I do? I'll tell you what I did. I talked to everybody I knew. I got as educated as I could, as fast as I could. Part of the way I educated myself is through YouTube. I owe YouTube 2013 through 2018. I made a video a week or thereabouts. I guess I took some time off somewhere in there. But the whole point of that was I'm going to learn it well enough to be able to talk about it on video. And through that, I'm going to learn. So I got a question twice. I made a video, how do escrow accounts work. I got a question twice. What is a gift of equity transaction? Made a video about it. Got a question a few times about mortgage insurance. Made a video about mortgage insurance. I kept doing that until I learned. And then after a few years of doing that, you're like, man, I know a lot. Knowing a lot is one way to provide value to people. And I think that whether it's mortgage or whether it's selling widgets, when you're providing value, people will seek you out and do business with you. So there's that. And then there's just your network, right? Whether you're super involved in your church or you're super involved in your kids' Little League or you're super involved in your CrossFit gym or you're super involved wherever you're at, wherever the people are around you, people need mortgages. They've got to like you and trust you enough with the biggest transaction of their life most of the time. And so, that's overall advice. All right. Holy 2 hours and 10 minutes. I got to get rolling, people. I got to get home. I got a family. Don't stop unless your credit is already toast. That's good advice. They're not going to take you to court. Yeah, I like that advice, Tim. If it's sub 550, just forget about it. If you got something to salvage credit wise, then yeah, maybe keep paying it. Try to do it. Is the minimum down for jumbo always 10%? Yeah, I know people that were looking for 5%. I don't think they're out there. And depending on 775, the county you're in, will depend on what the jumbo limits are. Because you can buy 775 in lots of parts of California and still be a conforming loan. Up to like 822 loan amount in a lot of counties here. Thanks, Timbo, for this advice. And I'll tell you from personal experience, Daniel, he's exactly right. You can always rebuild your credit. I had some serious credit issues in the early 2010s. Had a bunch of stuff going on personally, and my credit was absolute trash, and turned it around. So no matter what's going on, you can always turn it around. And you'd be surprised. I talk to people all the time that filed for bankruptcy, and then 2 years later, they got a 750 credit score. Yeah, talk to a credit person. If you've got a bunch of debt, you might even talk to a bankruptcy attorney, but know that you can always turn it around. So I like that advice. I appreciate that. Every 2 years, I do taxes. I'm a tax pro. Well, shoot, keep coming back, Maria. We need you in our corner. When I have to defer to a tax professional, I'm going to Maria Reyes. All right, cool. Well, that answers your question, JJ. Every 2 years. Look at that. Capital gains exemption, 2 years. Man, that would be kind of cool if you did like live-in flips. I wonder if you got clients that do that, Maria, where they like do a live-in flip, buy it for $250, rehab it, sell it for $400 2 years later, move into the next one, live-in flip. No capital gains. That's nice. Tej Beer just cleared your MLO exam. Here's what I would say to you and anybody who's brand new. It takes a while to get traction. It takes a while to get started as a loan officer. You're not going to do 5 loans your first month and 7 loans your second month and 12 loans your third month. It's just not going to happen. I was super motivated. I was going to 3 networking meetings a week. I was busting my tail. And I'll tell you, I think that my progression in 14, 15, 16 was probably better than most, but it was still 27 loans my first year, 50 loans my second year, 81 loans my third year. And so if you're in a position right now where you're making great money, you don't necessarily have to leave that. Maybe you start to build that mortgage business part-time, depending on how young you are. Skip Netflix, skip all the other BS and work a day job where you make good money like you stated. And then maybe you can work 5 or 6 hours as a loan officer. You can start to do marketing. You can start to do things that are going to get your name out there, get yourself educated. I mean, shoot, start a YouTube channel, make 2 videos a week, educate yourself, get better. Then you close 1 loan. You're not worried about closing loans because you got a full-time day job. You close 1 and then you close 2 more, then you close 4 more. And then after 7 months, 8 months, you're like, you know what? I got this. Then you cut ties with the old job and you're off and running full-time, full speed, doing 10 loans a month or whatever, you're trying to work up to. So, yeah, that's what I would probably do if I was you. I mean, I was, just had my second kid. My wife was at home caring for the boys, the most important job in the world. I quit a full-time finance job for the state with benefits and just went burn the boats. I had to succeed. So that's why I was probably working so hard. So I did it a little bit different, but you could do it with a little bit less risk by doing it on the side, at least for the beginning. All right, Maria, I appreciate the kind words. And glad to hear that you've enjoyed the videos, and good luck on buying the house. The cool part is you've seen as a CPA all the benefits of home ownership. So I'm sure you're stoked about being able to take some of the tax incentives, some of the write-offs from owning your own house. So best of luck to you. Let me know how I can help. Yeah, buyer's inspections always return something. So, inspectors just, they have to cover their own behind. So they're going to find something without doubt. Right. And so like you already had an inspection and corrected all the findings. The buyer's going to see a few things, be like, I want a $500 credit for this dry rot. That's my guess. Mortgage broker is faster, cheaper, and better. A big bank like Chase or Wells, if you've got $900,000 in deposits, they're likely to give you smoking rates on a jumbo loan, and a jumbo loan only. They offer probably an incentive for the smaller loans, but really where you see it most is like they'll give you a smoking rate on a jumbo loan as long as you have those deposits. Sometimes they'll even incentivize you, say, hey, we'll give you a quarter better if you bring over $500,000. But for your average vanilla, $400,000, $500,000 loan, mortgage broker versus bank, not even close. I got banker buddies that call me and they're like, listen, dude, this person might call you. We're way off. Like, I've got no chance at this loan. Yep, that's it. That's what I would do. All right, 2 hours and 17 minutes. It's been a long night. I'm tired. I appreciate everybody who joined. Every Monday, 6 p.m. Pacific Standard Time. Come back next week. Bring a friend. Let's try to get to 100 people watching this thing at once. Hopefully, I provided you some value. Like, comment, subscribe. Go check out. I've got 450 plus videos on the channel. If there's something you don't see that you'd like for me to cover, please just ping me, leave a comment. I try to read and respond to all the comments. It's getting to be a taller task than it was last year when I didn't have nearly as many subscribers or comments, but I'm doing my best. Hopefully I provide you some value. Have a great night. Thanks for watching.